EQL just takes the 11 GIC sectors in the S&P 500 and weights them equally. And so naturally, you're going to have a much more balanced sector profile than an equal stock weighted portfolio.
All right, joining me will be Zeno Mercer, head of Robotics and Artificial Intelligence Research at VettaFi, along with Paul Baiocchi, head of Fund Sales and Strategy at SS&C ALPS Advisors, who's, of course, a $20+ billion ETF issuer. And these will be two separate conversations, but we're actually going to cover a number of related topics, including the recent SpaceX IPO and how that's impacting markets and the ETF world right now. Certainly a lot going on there. We'll also discuss forthcoming IPOs from OpenAI and Anthropic and talk about those from an ETF perspective, to include these new Mangoes ETF filings from several issuers last week. Mangoes ETFs. I'll explain that if you're not familiar. Let's see. We'll also get into some ETF categories that are both benefiting and suffering as a result of the rise of AI, and companies like SpaceX and OpenAI and Anthropic. A lot we're going to cover with our resident AI and technology expert in Zeno, and then an excellent all-around market and ETF resource in Paul. It should be excellent conversations. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me first welcome in VettaFi's Zeno Mercer, who's joining us from Tampa. Zeno, it's been a while since you were last on here, but welcome back to the podcast.
Thanks for having me back. Yeah, I mean, good timing with all the action that's happening, which is normally, maybe a quiet summer. It's not really quiet so far, so good to be back.
Well, let's start with the SpaceX IPO, which, of course, that stock debuted a couple of weeks ago. It IPO'd at a price of $135 a share. It then quickly popped about 50%, and it's now down about 25% from that high. It's currently at around $155 a share. I would love to just get your initial impressions of the IPO itself and how it's traded thus far, and anything else standing out to you with SpaceX, which now has a roughly $2 trillion valuation.
Yeah, no, you're right. It is about $2 trillion. No, I mean, this has been a very anticipated IPO for a very long time. This, just like the story of SpaceX itself, it's been a long time coming. It's a gigantic feat. We talked about, Find You on X. That's part of SpaceX. So even now we're seeing kind of a lot of components of companies that Elon didn't start X, but he's acquired it. He created XAI, which is the AI arm. But now you've got this multifaceted, let's call it digital and physical AI company that's now public markets led by Elon Musk, with his gigantic targets on his personal valuation benchmarks. SpaceX popping out the gate isn't surprising. It was very anticipated. Lots of indices fast-tracked it, kind of like changing the game of like how agile the space, and also shows how agile the space has become to be able to do that, where investor sentiment and demand is saying like, hey, this is the kind of stuff we want. We don't want to sit back on innovation. We've already been a lot of investors, whether retail or advisors, have felt benchmark on the sidelines, to do some World Cup speak, of not being able to participate in a lot of these like really powerful names like Anthropic, OpenAI, SpaceX. And so, obviously, the valuations are very high. There's lots of anticipation around what types of markets exist within the SpaceX, where, whether the reusable rockets, the Starlink, which is obviously one of the breadwinners there. And if you look at the numbers, there's only like 10+ million subscribers, and you look at the, how many people live in the world, persistent internet for everybody, and devices, like that's a pretty big TAM. So, it's an exciting play. I think the takeaways, to summarize this, is, it's great for the markets to have this type of company in the public markets. It's going to bring more companies in the public fold, but it also redistributes wealth back to these like VCs and others who are going to redeploy capital. And I think we're going to see a lot more M&A, a lot more IPOs and late stage capital flowing into companies that are in that physical AI and digital AI space. So again, this is going to be an innovation flywheel. You're going to see people leave SpaceX Mafia over time. But again, really interesting time to be alive to see a company like SpaceX going public and quickly into the markets.
A lot you just touched on there, but I guess let me ask you this. As someone who's an expert in robotics and artificial intelligence and other areas where there's extremely rapid development, but also a lot of uncertainty around how the future will play out, I'm curious how you think about the valuation of a company like SpaceX. Like, I'm sure you saw Elon said last week that he sees SpaceX hitting 1 trillion in revenue by 2030, 1 trillion in revenue. How do you get your head around something like that?
I mean, look, we are in unprecedented times where we are seeing the convergence of AI kind of connecting and adapting to skills in the real world. I mean, one of the things we always talk about and look at is like what percentage of look at GDP, top, bottoms up, top down, what are the products, services, things that exist today and what will that look like in the future? And that's always evolving, right? There's markets today. The internet didn't exist. So now you've got the nexus of all of those technologies come together. That's going to make new markets. More things will be automated. SpaceX is in prime position to be a part of the connectivity. Obviously the space angle, they've got AI. They even have user platforms. Elon's always expressed the ambition to have the super app that can do everything. So there's a lot of value capture opportunities, but that is still a 53x jump in 5 years of revenue. And so you really have to anchor the ambition to real money. There's also competition. They're not the only player in the game. You've got companies like Delta partnering with Amazon for their satellites, right? And that won't come online until an expected 2028 or beyond. If you also look at like 1 trillion GDP, that's 3% of all US GDP. Total global GDP is around 115, maybe climbing to $120 trillion. So at the end of the day, it's like what slices of GDP will SpaceX capture? What markets can they plan? What new markets can they make to capture new value? And again, how does the competition, the suppliers, other components of GDP look like? Because he also has Tesla. So that's the question too, is like, does he merge Tesla? Do they compete? That's going to be an interesting thing to watch itself is Tesla versus SpaceX or with SpaceX. And they already have a lot of partnerships between the two. But again, there's a lot of players in the digital and physical, let's call it automation space right now.
In addition to SpaceX, we mentioned that there are these two other monster IPOs that we could see later this year, OpenAI and Anthropic, which both of those could easily see valuations north of $1 trillion. How are you thinking about those companies at the moment? These are both right in your wheelhouse, given what they do. Any thoughts? I mean, whether you want to compare and contrast those to SpaceX?
Yeah, I mean, both are obviously AI, data center model forward. They've both started developing more products and services for enterprises, consumers. OpenAI is working on their own robotics lab, other products and wearables. Maybe even a phone is rumored. So that's, again, don't think of these companies as just model providers. They're platform plays. Same with Anthropic. I mean, Anthropic's one of the fastest growing companies in the history of mankind, and on like a per revenue basis, the way that they're, using harnesses. I mean, most people are still using chat with, one-on-one chats. They have, their engineers and even non-engineers are basically managing loops of AI agents that manage other hundreds of swarms of agents. So they're just, this development cycle flywheel is incredible. And of course, you have to fact check it. So they have the, armies of like cybersecurity. We saw Mythos shut down by the US government, also known as Fable. And so again, these are platform plays. They're infrastructure and distribution. It's not just the model. But even these players have competition against things like Chinese mixture models and even open source models, right? So at the end of the day, they have to, even if they're the best in the world, they have competition against just call it economics, right? So if enterprises are like, well, we're getting like 95% of the results with our own custom open source model on our own hardware or rented cloud, you might see pressure that knocks down top line or even margins against some of these players if they can't continue to stay ahead. So even these large players, they're still, again, being bullish on AI. I use Claude and ChatGPT every single day of my life. I have both running while we're talking right now. Like they're working on research, they're doing other things for me. Like, this is I'm trying to understand it, use it. But I also have open source models operating as well, and they're cheaper. But they don't have subscription plans. It's a cost per token basis. So at the end of the day, they're going to be huge companies. They're not going anywhere. They're going to keep innovating. Both are moving very fast. Anthropic, I'm not as aware on the kind of like the hardware side, the physical AI. That's something I'm seeing more from the OpenAI side, but I wouldn't be surprised to see Anthropic start to make moves in that direction as well. And both will be very popular IPOs. Like they are going to be oversubscribed. They're going to knock it out of the park. They're going to probably be fast tracked into every single index that can be fast tracked into.
Well, let's talk more about that and just the ETF side of the equation, which, by the way, did you see that several issuers filed last week for these Mangoes ETFs, which, by the way, people aren't familiar. That stands for Meta, Anthropic, NVIDIA, Google, OpenAI, and SpaceX. It's like the new FANG or MAG7. I'm assuming you were already aware of that acronym, or is that new to you?
I've heard Mangoes before the IPOs came out, or before the ETFs were filed. I still think there's other names in there that maybe should be a part of that. I mean, Amazon has a lot of effort in robotics and AI as well, chips, etc. So maybe it's Mangoes. But that being said, these are, I think, what many people consider 1, 2, 3, 4, 5, 6 names that are eating a lot of the world right now, and very publicly as well. I mean, people are watching it play out in real time. So it makes sense, if you believe in disruption and the value capture they can play into, they're going to be very hot names. They're all going to be very, outside of like Google, maybe, like the rest of them are going to be very expensive for the most part. I mean, SpaceX, very expensive. So a lot of it is future bet, not as much discounted to other names that might be overlooked. But, again, it's a lot of the AI value chain captured in those names. But it, again, misses, I would say, a lot of kind of the physical AI and other, upstream and downstream players in it. But it makes sense. I mean, you've seen the MAG7 be a successful ETF. You've got, obviously, the QQQ, NASDAQ 100 has been capturing top 100 for many years. So it makes sense that somebody that wants to focus in those names alone, it makes sense. But it's very concentrated. So now you're at risk of kind of the global scale having impact of like open source models, things like that. So again, I think it might make sense for like a sliver of a basket to just get those names if you don't do it directly. But I think all those names will also be pretty heavily weighted in the Qs and S&Ps eventually. But again, it's just like, I guess risk profile and belief systems around, broader based rising tide or concentrated bets.
Talk a bit more about some of those overlooked names or just overlooked areas within AI. And let me frame it like this. Obviously, those Mangoes ETFs, those are going to take some time to come to market. But to your point, it's obvious these are very concentrated in these big names. And I would say, even if you think about the Qs or some of these other broad indices that will add some of these names as the float improves and earnings improve, you can make the case that if you're a long-term investor and you have exposure to, say, the S&P 500 or the Qs or whatever ends up adding these, that you're covered here, right? You have exposure to these big names that theoretically will benefit as the AI story improves. And then if you want to double down, you can look at these Mangoes ETFs. But what you're saying is there's opportunities beyond that. And I'd love to have you talk more about that, some of these overlooked areas.
Yeah, I mean, think about, there's preferences, there's politics, there's a lot that goes into how consumers and enterprises and governments purchase and make purchasing decisions around the world for defense, for medicine, for consumer, household. Think of automobiles, right? You might argue that maybe there's like a best car in the world, but even if it has great sales, it's a very fragmented industry. And there's a lot of big players that supply into that, components. And again, you're looking at relative valuation. So just because you have the biggest company in the world, if it holds flat for 5 years, you didn't really get much. Where some of these other companies are playing into different pieces of the AI value chain. And again, as we look at, with the robo lens, the robotics value chain as well. So that physical AI. So at the end of the day, we talked about SpaceX. There's going to be competition. There's also different markets it's probably not going to play into. And again, it even competes with Tesla on the humanoid front. Humanoids, even themselves, are only going to be a fraction of, even if, let's imagine, superhuman humanoids everywhere. They're still not going to be all of the robotics movement. You're going to have autonomous mobile robots in warehouses. I mean, you're not going to see humanoids running down the highway carrying stuff. So again, you're going to have drones. It's a mixture of we talk about mixture of experts in artificial intelligence and harnesses and different models working together and fact checking. The same kind of like mixture of, let's call it, almost like biology, will exist in that physical world as well. And the physical world GDP is much bigger than the digital world GDP, and the services, like there's physical services as well. And so again, you can almost say it's like, what's the moat at the end of the day? And also, what companies will all of these be using? Like, you've got Google, multiple of these contracting with companies like MediaTek over in APAC, and it's crushing it. And it's, it works with NVIDIA, and it also works with all the companies trying to offload off NVIDIA. So, you've got all these players, and they're relatively smaller, but they're providing tremendous value and specialization and services that these players can't do themselves. And so I think if you go down the line of each value chain, you have a lot of underappreciated, less covered names that exist. And they're all right now they're crushing it. You've got Teradynes for semi-chip inspection. So you've got the Japanese robotics companies that are selling to China, selling to Japan. Japan just came out with a new robotics strategy and in physical AI investment, and they sell to the U.S. So you've got these omni-channel geographies and omni-channel end markets. Non-geography, but like selling to traditional and next-gen consumer AI, whatever application exists. And so that's where it gets really exciting that a lot of these companies are again not talked about. They're not overweighted. And so, you're going to see like a really fast overweighting into a lot of these mangoes. And that, means that you won't, that you have to hit a higher bar versus, what are these people buying that have, endless checkbooks? And I think that's where it gets really interesting.
And so for ETF investors, where should they be looking? I mean, is this looking at robotics and AI ETFs? Obviously, VettaFi is behind the Think Index and the Think ETF. Is it looking to a play like that? Or are there other areas? I'm just, with everything you laid out, if I'm an investor and I do want exposure beyond Mangos or some of these top names, where do I go?
Look, I mean, even in traditional economy, we're seeing kind of the SaaS apocalypse happening with a lot of what have been very big companies that kind of transformed, let's call it analog to digital. And now we're seeing AI disrupting that. And again, as you kind of alluded to, there's a whole ecosystem that enables that. And so we think that is one of the goals we try to find is, analyze the companies that contribute to that value chain, the distribution, the cybersecurity, all those elements. The physical AI side, that story is not even started yet. I mean, if we surveyed 1,000 Americans, how many robots did you see today? Some might have a Roomba. Like this TAM is not even getting started. And I would say that's probably, as we're getting into kind of this like peak AI cycle, and now it's a flywheel that's going to start trickling more and more into robotics. In fact, the SpaceX IPO, as I alluded to, is going to unleash a lot of capital into pushing forward investment into AI models that other companies are going to be able to use, like Volkswagen, all these car makers, all these traditional robotics companies. They're not going to stand idle. They're going to use AI to improve their products. Like this, there's a company called Mitsubishi Electric, right? In Japan. It's an old school robotics and automation company. Lower valuations compared to any of the high flying private robotics companies. They're working on robotics and AI and drones and humanoids, right? Like these are not idle companies, but the valuation disparity is huge. So those are the types of opportunities where we feel overlooked by the public markets, underappreciated. Everyone's following the high flying names and not appreciating that these companies are profitable, have high distribution, years of manufacturing excellence and distribution excellence, and they can partner and build their own. Like they can partner with a company that makes great hands. They don't even have to make the hand to have that ability to sell their robots and partner. And so even the system integrators like ABB and Siemens, very interesting plays right now to help put it all together, because there's a lot happening, and that's their specialty, is putting all this stuff in the digital physical world and making that accessible to increasingly smaller, like mom and pops and SMBs shops, which a lot of American factories and logistics plants are still under automated. households very under automated, and we've got aging populations that are going to need more and more of that to sustain itself. So again, these are the types of things where we look at like the macro trends and all that, where we see a solid convergence on.
Okay, so what about the other side of the equation? You've been highlighting areas that maybe are overlooked that stand to benefit from the rise of AI. Are there any ETFs or thematic ETF categories that you think investors should be cautious of right now as a result of AI? And I'll suggest something like software, where if you look at, say, the iShares Expanded Tech Software Sector ETF, ticker IGV, that's down 17% this year. Is software the most obvious example, or are there other areas investors should be keeping an eye on, again, from a potentially negative standpoint?
Yeah, I mean, that's going to be one to watch for a while. Obviously, valuations have already, we've seen a repricing for a lot of these names. I don't think that story is going to go away. I mean, we were investors in, like we had companies like Wix, Adobe, lots of the name years ago. They were leaders, and we had to remove them years ago because we saw, from, for example, like Think, because we saw ChatGPT, generative AI, leapfrogging what they had been developing. So SaaS is still one to watch, but that feels too obvious. I'm trying to think of a less obvious one. I'm still bullish on electrification, which is kind of where AI and robotics, they both pull a demand curve into, and both play into. They're both helping the distribution and creation of energy. What else is at risk? I mean, I'm trying to think. I mean, healthcare technology is still strong. Like we're going to see a flywheel of that. I don't know if you saw. Did you see? What is it? Mistral. This company, I think it's Mistral, partner with our. I'm getting that wrong, but I think we're going to see a lot of advancement in healthcare technology, and I'm curious to see how the payer systems and others evolve with that. Because you've got revenue cycle management. You've got, even let's see. It's a tough question. I need to think more on that side of it because, but it's fair to say that you will continue to see certain markets almost cannibalized by AI or robotics, and at the benefit of the individual and the consumer at the end of the day. But there will be I guess as always when there's kind of a technical revolution, there will always be areas that are displaced.
Well, let me ask you this. Let's go back to software. You mentioned SaaS, software as a service, and that is the one that I think everybody's pointing to, and the performance would show that. Is there any hope for software as a service? Is there a case you can make going forward that this will be a decent spot to be, and that maybe AI can help boost it, or is it all negative?
Yeah, I mean, I think companies that like a Salesforce, something that at the end of the day, there are some network effects, but at the same time, there are also just a lot of companies are just glorified databases with the UX and a little bit of smart on top. I've built my own CRM. I don't even code, and I was able to do all of this. It's more customized, and guess what? It costs my ChatGPT subscription, right? And so at the end of the day, more and more people are going to be able to do that as it gets better at onboarding. Like AI itself is going to be tailored to be able to onboard, non-tech people. It's going to become easier and easier. You're going to be less and less technical to be able to do things that you used to have an entire team of people needing to operate. So that is going to be very deflationary for the cost of a lot of services. I mean, even I brought up healthcare, but it's I know people that are not even wanting to go to their primary care physician right now, and they want to just quarterback their own stuff and go hey, I'll pay out of pocket for this thing. I don't want to go through hoops. I don't want to wait months to get a doctor visit to then wait for insurance or something to go do this. I think we might even see more medical tourism from that, where people are just, it's hey, this AI is beating, legal, others. So I would say that professional services in general might be at risk. And I know that's not a popular thing to say. I won't be popular saying that like that. I know that's not a popular take, but if you're the individual, if you're, in the lower income brackets, wherever you're at, it's you will have more access to higher quality services. And I think at the end of the day, that's going to be expanded globally and more, it's a great equalizer in many ways. And so, when we talk about, I saw a note from Goldman or somebody, they're AI will be inflationary for XYZ. I'm okay, well, look at all the components of things people aren't buying because they can't even afford it. And I think you're going to be able to provide greater services, personalization, like, coaching, whatever it is, to like stop paying for things you don't need to spend. Like I had to go through like a family member's budget and they're like, hey, they're over 65. It's like, well, you get a discount here, this here, saved $500 a month. You know what I mean? That's incredible. And so at the end of the day, I do think we're going to see a reshuffling of how money is extracted from individuals and consumers. That's a big change. And so that, think for yourself, do your own research on like, what are the implications and upstream and downstream impacts of that? But yeah, I think there's a lot of like really macro meta things happening here. And just think about it and use these tools. They're great.
Yeah, and that you're painting the challenge, right? AI is everywhere, and there's clearly areas that are benefiting. There's areas that I think are going to suffer from it, and I think trying to figure out what those are, that's the challenge, which is why some investors go, you know what, I'm not going to do anything. I'm just going to invest in the broad indexes and let those, work themselves out. But obviously, if you want to try to accomplish more than that from a portfolio perspective, you have to either find the areas to be invested in or the areas to avoid. But Zeno, we'll have to leave it there. Great having you back on the podcast. Excellent perspective as always. Thank you for joining me.
Thanks, Nate.
That was Zeno Mercer, head of Robotics and AI Research at VettaFi.
Navigating the ETF market? Get the precise data and analytics that smart investors rely on. Build a stronger portfolio today at etfdb.com.
I'm now joined by Paul Baiocchi, head of fund sales and strategy at SS&C ALPS Advisors, who currently offers 26 ETFs, over $21 billion in assets. And Paul is simply one of my favorite industry resources to visit with. He can talk ETFs, markets, industry trends. He can cover it all. And he's now joining me from Denver. Paul, always great having you on the podcast. Thanks for joining me.
Thanks for having me. Always great to see you, Nate.
All right. So I was just discussing the SpaceX IPO in the prior segment, actually, along with the upcoming OpenAI and Anthropic IPOs. And you obviously know the story here, where we have SpaceX now valued at around $2 trillion. The expectation is that OpenAI and Anthropic will go public with valuations somewhere around $1 trillion. I'm just curious how you're viewing all of this right now. We can certainly talk ETF impact in a moment. I'm just curious how you're thinking about this from more of a market perspective.
We've been, over the course of the past couple years, I think, fighting the urge from a financial media perspective, from a commentary perspective, to make this current market moment fit the analogy of, say, the dot-com era. And one of the things that everyone pointed to was a lack of IPOs, a lack of headline IPOs, perhaps the type that we're seeing now. And so in some ways, it's validation for the appetite, I would say, for some of these companies and some of the technologies behind them and the opportunity that these companies provide to investors longer term. But at the same time, it certainly makes it feel as if the analogy to the dot-com era rings a little bit more true than it might have pre-IPO frenzy, if you will. And there's other companies coming. You mentioned a couple, and certainly SpaceX is on the top of everybody's mind, and it's going to be added to indexes like the NASDAQ here very soon. And then the S&P seems to be dragging their feet a little bit, and they'll be adding it next year. And so the implications from an index perspective and from an ETF perspective as a result are going to play out, I think, over the course of the next few months and into next year. But we've got other companies coming. I mean, Anduril is another company that people are really focused on in the defense tech space. And I would say it's a convergence of space, of data center opportunities, of satellite internet, of AI, of defense technology, all of which are very fascinating and speak to the ingenuity of the U.S. economy and of the people behind a lot of these companies. But anecdotally, one of the things that people always said about, say, the Great Depression or the Great Crash back in the late 20s or even the dot-com era was one indication of the bubble was when you had your taxi driver or someone at a cocktail party asking you about stocks. And I will say that in anticipation of this IPO, I did have people texting me about SpaceX, which might be anecdotal, but in some ways is representative of where we are.
I had the exact same experience. I think, as you know, I run an investment advisory firm, and we've never seen so much inbound interest from clients wanting an allocation to any IPO. So I think, to your point, there's definitely a little bit of a frenzy here. You started heading down the path of the ETF perspective to all this, and I'm sure you saw that there were a bunch of 2x leverage and inverse SpaceX ETFs that launched last week, one day after the IPO. And actually, there was one that launched the day of the IPO, but it was then halted for trading. But point being, Paul, that we are seeing issuers race to offer exposure here. And there have also been a number of active ETFs that have added SpaceX. There were some that already held it, whether directly or through a special purpose vehicle. Index-based ETFs are starting the process of adding exposure. How is ALPS thinking about all of this, whether we're talking SpaceX specifically or IPOs more broadly? Do you have a framework here around IPOs?
I would say the best way to sum it up is we don't really think about it in the context of our product suite because, as you know, Nate, we do have active solutions, and our active managers, of course, have discretion to add stocks or bonds based on their outlook, their positioning, their research. I would say on the index side, we're beholden to the index methodology. Many of those indexes underneath our ETFs, of course, are provided by VettaFi. And so we're always in close contact with our index providers, our index partners, just through the course of business. And so I would say, given the nature of our suite, a lot of factor-based strategies, some are thematic, none of them are, say, space themes or even AI-focused themes. Some of them are AI adjacency themes, like an electrification infrastructure strategy. But by and large, I would say most of these things don't touch our radar from a product perspective. They touch our radar more from a market outlook, market positioning perspective. And certainly when we're talking to advisors and we're engaging with allocators, it's impossible to avoid the conversation around AI and the coming IPOs in the category, as well as the recent SpaceX IPO. But by and large, in many ways, this just presents an opportunity for us to ground people in some ways to the impact of some of these dynamics on their portfolio, some of the risks that this creates in the market. I think, as you know, Nate, a lot of the coverage in financial media has been around where's the capital coming from for, say, an Anthropic or an OpenAI or even a SpaceX IPO. That money has to come from somewhere. And is it the cash on the sidelines that we've been reading so much about? Is it repositioning around some of these meta and or hyperscaler companies? In many ways, I think that's the push-pull of the market at the moment, is where is capital coming from to fund these companies? And then importantly, what are the implications of that if you're just heavily indexed or you're allocating to growth-oriented segments of the market? And that's a real challenge for advisors, especially because me getting texts, you getting inbound calls from your clients, in many ways, that's probably just a snapshot of what advisors across the country, around the world, are dealing with. Advisors trying to service their clients' long-term goals as part of a comprehensive plan and an asset allocation framework, and having to have conversations about one-off stocks that may or may not be part of a portfolio. Getting back to the idea of double leverage, single leverage, buy right strategies, because options are coming on SpaceX. That's the type of stuff, in many ways, just fundamentally, that I struggle with in terms of whether or not some of these product launches are really additive to the investor experience. They might be additive to the trader experience. Certainly the convergence of prediction markets and gambling and the coalescence of all these things has changed fundamentally how some people interact with the market, broadly speaking. I don't know that it changes necessarily that baseline foundational concept of I need to get here financially based on my goals and my view of where I want to be personally. And then how do we get there from an asset allocation perspective, from a planning perspective? And that's the one thing you don't want to lose sight of is what actually matters long term.
All right, several threads we can pull on there. Let me come back to sort of this active versus passive as it pertains to IPOs. And maybe that terminology doesn't even matter anymore because we are seeing index providers change their rules on the fly, which that's not really passive. But again, as an issuer who offers both active and passive products, would ALPS like to see rules changed on passive products, or are you saying that's what active is for? I'm just curious, like your view on, how we have seen index providers change their rules. And you mentioned you use VettaFi for a number of indices. I'd love to hear more about how you think about that, or if you have any strong views.
Yeah. I mean, it's a good question. It's really philosophical, and in some ways, the largest index, the most widely followed index in the world, the S&P 500, is kind of active in the sense that there's a committee and they make a decision around whether or not a stock gets added. They have a screen, if you will, for profitability. So it's not as if even the most popular index is fully passive, fully rules based. So I think there's a misunderstanding in some ways of what constitutes truly passive, what constitutes truly active. And as you know, Nate, and as we've talked about previously on this podcast, there is this gray space between full-blown active and full-blown passive that's represented by factor-based, rules-based, systematic strategies. And so as far as the types of indexes that underlie our ETFs, I don't know that it's in the best interest of end investors for them to reconfigure or overhaul their process to accommodate a new IPO. And I do think that that's why active managers exist. Famously, there's been fewer and fewer IPOs over the course of, let's call it, the past 10 years. A lot of companies have chosen to stay private and for longer periods of time than they otherwise would have. That's impacted small caps, for example, because companies once upon a time would go public at a smaller valuation. They'd cut their teeth, if you will, in the Russell 2000. Maybe they'd graduate to mid caps and then maybe eventually graduate to large caps. Now, when you IPO at north of $1 trillion, you're automatically in not just the large cap, in the mega cap sphere. And so I think it's altered the way that the public markets represent the investable universe of companies. And so getting back to the idea of active versus passive, in theory, a lot of active managers in the mutual fund wrapper, and certainly to a degree, as you mentioned, through special purpose vehicles or other avenues, have been able to invest in some of these private companies. So people have the opportunity to get exposure to these companies, both on a pre-IPO and post-IPO basis through an active manager who they can trust. But of course, a lot of active managers naturally have a framework for valuation, fundamental analysis, value-oriented analysis. And I don't know that these new IPOs fit that framework because of the sort of asymmetric nature of what they're trying to accomplish.
To your point, these companies are coming public. They're so large, they're already mega caps. And I was thinking back to some of our previous conversations where we've really had discussions around market concentration. And bear with me here as I try to frame this properly. There are a number of indexes that are adding SpaceX or set to add SpaceX pretty soon, including the NASDAQ 100. And it might take some time depending upon the different index provider rules. But longer term, adding these big IPOs would seem to point to additional market concentration in the big market cap weighted indices, right? As float improves and perhaps earnings improve and those sorts of things that determine the weighting in an index, I think we have to assume these big IPOs will work their way towards the top of the holdings because the valuations are so massive. Does that give you any concerns? Again, just this further concentration of market cap weighted indices?
I think it does. And it's not just the big indexes that face this challenge. Famously, the Mag 7 represent a massive percentage of the S&P 500. The sectors where the Mag 7 live, so discretionary, comm services, technology, represent more than 50% by weight of the S&P 500. And so this concentration is germane to these big, widely followed indexes, including the NASDAQ 100, but it also has cascading effects. So you think about sectors. So historically, we've always believed sectors are a very powerful tool for affecting your economic outlook, certainly more acute and a better tool than, say, using growth or value or a style box framework. But because of the massive concentration, not just in technology, comm services, and discretionary, but also in other sectors of the market, S&P had to change their rules for those indexes within the confines of the 2550 or the RIC compliance. And so concentration is not just an issue in major market indexes, it's an issue at the sector level as well. And naturally, I think the impulse most investors have when worried about concentration is to just default to, say, a single stock equal weighted methodology. So just take the 500 stocks in the S&P 500 and equally weight them. And naturally, the offset is that you get less of that concentration risk in those large companies, but you introduce other risk. Typically, that's a higher beta strategy. You get more volatility because you're giving the same weight that you give to the largest company in the S&P 500, famously right now, NVIDIA, to the 500th largest stock in the S&P 500. So you're almost trading one risk for another, concentration risk for size bias as well as increased volatility. And we've argued over the course of the past couple of years that that's not necessarily the solution. That in many ways is introducing another challenge while you're trying to solve for concentration risk.
Well, this is actually a perfect segue, Paul, because ALPS does have a solution here. You offer the equal sector weight ETF, ticker EQL, which that's seen some nice inflow so far this year. And to your point, equal weighted approaches are an obvious place to look for investors if they are concerned about market concentration. And I do think these big IPOs might further accelerate interest around equal weighted strategies. But I'd love to have you maybe compare and contrast EQL versus, to your point, some of the single stock equal weighted approaches out there.
Yeah, so simply put, EQL just takes the 11 GIC sectors in the S&P 500 and weights them equally. And so naturally, you're going to have a much more balanced sector profile than an equal stock weighted portfolio, which is basically just saying which sectors have the most stocks in it and those get the most weighting in the portfolio. And so you end up having high exposure to a lot of the same sectors. It's just a different makeup because you have equal weight to the largest company in a given sector as you do to the smallest company in a given sector. And so if you look back over, say, 5-10 years or so, what you see in terms of comparisons against an equal sector weighted versus an equal stock weighted is shallower drawdowns in the equal sector weighted portfolio, which I think makes sense when you think about giving more weight to sectors like utilities, which are historically defensive, and consumer staples, again, a historically defensive sector. And naturally, I think that sector balance is what investors and advisors are trying to accomplish when they're equal stock weighting. They're just less familiar with an equal sector framework. And one point I'll make here, Nate, is that we recently changed the methodology on EQL. Once upon a time, it was a fund to fund. So it used ETFs as the underlying way to affect that equal weighted strategy. We recently partnered with VettaFi to change that index. And so now you're using the actual stocks to affect that equal weighted strategy at the sector level. But importantly, you can maintain, without those concentration rules around the S&P indexes in the S&P 500, you can actually get representative exposure at the sector level. So you're actually tracking the individual sectors more cleanly, even though they're equally sector weighted. And that's an important distinction. We also lowered the fee because you no longer have embedded fund fees. So that methodology change is something that we're very excited about. It was sort of some, I would say, months or years in the making. And on a go forward basis, we expect it to be a really powerful, popular portfolio tool for allocators who are looking to offset some of this concentration risk in their client portfolios without overhauling everything. You can add, say, EQL to your S&P 500 index ETF without having to realize capital gains as an augment as opposed to a replacement.
Obviously consider EQL a more core portfolio holding. It's a broader play overall. But I remember last time you were on here, we were talking about some of the quote unquote old world categories that were actually benefiting from AI. So we were talking about utilities and materials, energy. And I'm just curious, is there anything new on that front since we last chatted? Like, I remember we walked through a boatload of ALPS ETFs covering these different areas. I think we focused on the ALPS Electrification Infrastructure ETF, ELFY, but there were several others. Anything you would highlight here, again, if we get a little more granular?
So we built a piece called The Electrification of Everything that lives on the website alpsfunds.com. I would certainly suggest anybody go and read that piece because it looks at the different exposures you can get to really build out a comprehensive textured view of the electrification theme beyond ELFI, which we believe is the anchor. And to answer your question, yes, things have changed because this is a very dynamic segment of the market. We just saw a deal yesterday between Microsoft and Chevron to provide power to one of their data centers. This idea that these companies are spending this CapEx, and when I say these companies, I'm talking about the Mag 7, I'm talking about hyperscalers, to secure not just access to chips and memory and all the stuff that's necessary to support their AI ambitions, but also to ensure that they have access to reliable electricity. This continues to grow and continues to evolve in real time. In fact, some of the decks we build to make that electrification case are outdated already because the numbers, forecasts, and the like for electricity demand growth are continuing to change right out from under us. And so in many ways, this is a modular theme in the sense that you can use ELFI alongside energy infrastructure, alongside commodity strategies or global natural resources equity strategies as a way to build a comprehensive thematic sleeve alongside your core equity allocation or your core asset allocation. And that in many ways is an evolution of how we talk about it. I'll tie it back to SpaceX because that's what's on everyone's mind. I mean, Elon Musk and the powers that be at SpaceX are talking about building data centers in space and having solar panels that are up in space and construction projects that actually take place on the moon. I mean, that just speaks to the insatiable appetite for data and electricity that we're sort of pushing the limits of what Earth can provide, and we need to start sending this stuff out into space. And so, if nothing else, the SpaceX IPO and some of the language in there around data centers in space underscores the opportunity we believe in the electricity infrastructure category.
I just love this entire conversation because, again, in the previous segment, we were discussing some ETF categories that investors might want to be cautious of right now just due to the rise of AI. And so the obvious one is something like software, right? Software as a service is clearly under some pressure due to AI. But, what you're talking about are some areas that could benefit from AI that maybe aren't front of mind for investors if you look beyond these big companies, which, by the way, I have to ask you, did you know there's now an acronym called MANGOs? Have you heard of this?
I did indeed, actually. I'm apologize for knowing it. In fact, the acronyms are getting out of control. But yes, that is a new one.
These are the biggest companies. And so I think investors naturally gravitate to the Anthropics and the NVIDIAs and the OpenAIs and the SpaceXs. And maybe they're not looking at some of these other areas that could benefit. And that's why I just think this is an instructive conversation. And whether we're talking about infrastructure or energy, raw materials, real estate, to your point, the things that, this backbone of electrification, these are clearly areas that could benefit as AI continues to rise.
Yeah, and in some ways it's part of this fascinating flywheel whereby some of the limitations on the grid. So the grid's old. We've talked about that. Everyone knows it's 100 years old. We sort of deploy electricity the same way we did 100 years ago. And the grid's evolving right in front of us. And some of what's going to unlock the potential of the grid, which, by the way, there's an underutilization of the grid of around 50%, and we need to get to a place where we can solve that. But a lot of what's going to allow that optimization is technology and the implementation of AI. A lot of what's going to unlock improved outcomes for energy companies, for materials companies, is the adoption and implementation of AI. And so in some ways, when you think about, say, physical AI, so robotics, for example, a lot of coverage of this. We're expected to see robots in our homes over the course of the next 5 to 10 years. We're already seeing massive applications of enterprise level robots around the United States. When you think about the different layers of demand for electricity just coming from a robot, well, you got to plug the robot in. The AI behind it is being run at a data center, which has insatiable appetite for electricity as well. And so all of these things relate to one another, but ultimately the physical reality, the real assets behind AI and the implementation of some of these technologies, including things like SpaceX, are ultimately constrained by things like power and what goes into it. That's the materials, that's the energy. And that's what makes the case in our mind for a thematic sleeve focused specifically on the beneficiaries of rising electricity demand, and not necessarily just the companies who are driving it, which are the ones that are in the Mango acronym, in the Mag 7, in that hyperscaler category, and importantly, the sectors that you already have significant exposure to in a cap-weighted view of the market or in a growth-oriented view of the market.
Paul, we just have a few minutes left here. If we put the AI story aside, I mentioned at the top, you are one of my favorite resources on ETFs and the markets. I just have to ask you, is there anything else that you're watching right now, whether it pertains to the market specifically or ETFs? And I know that's sort of a broad question, but with you, I just like to see what's front of mind. So is there anything else big on your radar right now?
Look, Nate, a lot of people know us because of AMLP, our largest ETF, the largest, most liquid MLP ETF on the market. And the energy infrastructure space is always top of mind for us. And so naturally, the news flow around the Iran conflict and the MOU and a possible resolution in the Strait of Hormuz and the implications for energy markets, in many ways, this conflict has underscored the import of energy infrastructure in North America. The pipes that we've built over the course of the past 10, 15 years, the production in the various basins around the United States has allowed us to have a level of energy independence and insulation from global energy market volatility that in many ways wasn't necessarily accidental, but is a product of the investment and the ingenuity in the energy category. So in many ways, regardless of how this Iran conflict shakes out, and I've heard the idea of a messy peace being sort of the knock-on effect of it, nothing is going to be a straight line. But when you think about our domestic energy market, the fact that natural gas prices really didn't budge as a result of the closure of the Strait of Hormuz, at least here in the United States, like they did in other markets, and we were able to incrementally increase our output and our exports of crude oil to fill in the gaps, if you will, globally, that speaks to, in our mind, the opportunity in front of energy infrastructure going forward as it relates to increasing LNG export capacity. And so I think AI captures a lot of headlines. SpaceX has captured a lot of headlines. And it's kind of remarkable to think that a conflict with the size and scope of what's going on in Iran and the closure of the Strait of Hormuz has sort of fallen by the wayside. But that's certainly something we're thinking about going forward, is how do we get this message out to investors who typically have very little exposure to the energy infrastructure category, has a lot of compelling portfolio characteristics, high yields on a relative basis, strong fundamentals, relatively low volatility within the energy sector. How do we get investors familiar with that, comfortable with it from a portfolio perspective, given that in many ways the conflict in Iran has shown a big spotlight on the importance of the energy infrastructure industry in North America?
You mentioned the AMLP ETF. Is there another ALPS ETF or two that you would also point to here to potentially take advantage of all this?
Yeah, so ENFR is the sister fund. That's the one that has both MLPs and C Corps in the category. That one does have more natural gas exposure than AMLP just by virtue of the revenue breakdown in the portfolio. Those are both products we're heavily focused on to capture the category. And those are, I think, products that a lot of investors just aren't all that familiar with.
Well, Paul, as always, greatly enjoyed the conversation. Excellent insight as always. Thank you very much for joining me.
Thanks, Nate. Great to see you.
That was Paul Baiocchi, head of fund sales and strategy at SS&C ALPS Advisors. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by Paul Marino, Chief Revenue Officer at Themes ETFs, who they were one of the issuers who recently launched leverage and inverse SpaceX ETFs. So we will certainly touch on those along with several other Themes ETFs. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.